The crypto market has been getting hammered recently, and last week's sell-off caught much of the market off guard, with Bitcoin down $15,000 off its recent highs, XRP down to the tune of 20% from its highs, and most altcoins getting sold into the grave. It's hard not to be ultra bearish with these types of dumps in the crypto market. But are we actually at the start of a dreadful bear market? In this video, I'll cover some important news you need to know surrounding layoffs, unemployment, the potential for wide-reaching bank failures, and other macroeconomic factors that could have a major impact on the crypto market and your portfolio. And in this video, I'm going to explain why selling now could be a major mistake and what you can do to make out like a bandit in 2024 and 2025 in the crypto market. I'll also dive into a few key indicators you can pull up on a chart to get a bird's eye view into the markets and feel confident about the decisions you make with your portfolio moving forward. And near the end of this video, I'll be sharing how I'll be approaching my XRP Ripple bags, my crypto bags, and some target buy zones closer to the end. So stay tuned. Hello and welcome to the Bull Runners YouTube channel. My name is Paul, and as always, our content is for education and entertainment only. It's not intended to be financial advice. Investing in crypto is risky, requires patience, solid risk management, and at no point in time are you guaranteed to make money. We also don't guarantee any results, so before you make decisions, do your own research and consult with a licensed financial advisor. Also, just as a note, we may hold some positions in some of the cryptocurrencies we mentioned on this channel, but that doesn't make it a recommendation for you to do the same. Results aren't typical, so don't be typical. Stay bullish, and let's get into the video. So I'm looking at a chart of the total crypto market cap. And as you can see here, this was relatively the technical or on-chain high for Bitcoin. And at the time, the crypto market cap was sitting about $2.5 trillion, right? Then when we made our actual all-time high, only for it to be a bull trap and a breakdown, and I would argue, an institutional play, right? They were able to get the market to break right above those previous highs, only for the breakdown. This would have been considered an uptrend, right? We still have a series of higher highs, and I'll go ahead and circle that first low, our next high, our next low, next high, next low, next high, low, high, and even right here, as you can see, this was still an uptrend. In other words, we have a series of higher highs and higher lows. Where we really started to get signals of a major bear move and a breakdown was right in not this range, but this range. And so if we started to break below these lows right here, then this was officially a bear market because the trend had directionally changed, right? You had now a all-time high, a couple of, double bottoms, if you will, a new lower high, and then guess what? A lower low, right? This was the range resistance. What used to be a support is now a resistance. And so we continue trending down, but not for that, from a percentage scale, not that far, or I should say a dollar scale. We were at about $1.2 trillion and then dumped to range lows of about $745 billion. So it's still a tremendous loss when you really think about it, right? But this right here was our indicator. And so right now, right, we're kind of in a range where, as you can see, we are officially in an intermediate term bearish downtrend. That doesn't mean that the bull market is over. It simply means that we have to practice some caution here. When you look at the price of Bitcoin, it looks very, very similar. Why? Because the majority of the money in crypto is in Bitcoin. When you look at XRP, arguably, it doesn't look too hot. Right here, we have a line from its actual low in March of 2020, right? Coronavirus. And then right here at our next major low at the bottom of December of 2022, that bear market with a large wick right here. And then we had our range support right here in April of 2024. And we continued ranging only to see the market, on a daily time frame break down right here and make new lows. So even XRP is not looking too good, but is it time to sell your crypto bags? Well, let's get into the news. So the first piece of news is that Jerome Powell, the Fed chairman, for the Federal Reserve in the United States is going to speak to Congress. He's going to testify to Congress this week. And one of the key things that, the Congress people are probably going to ask him is his view on the labor market. It says right here, Powell's current views on the labor market will be of particular interest. The risk that employment could slow too much if the Fed keeps rates high has grown. There are signs the labor market is moderating from the very elevated levels of early 2022. Last month, the unemployment rate ticked up to 4.1%. So as you can see here, we have a chart of the unemployment rate from the Bureau of Labor Statistics. And this is on a weekly time frame, but we only get the readings about every month. I'm not too sure. That said, right here, well, we could look, but we're not going to. We're not going to spend time doing that. Right here, we had our all-time high at the end of the Great Recession, right, which was like the housing bubble back in 2008 to 2009. It peaked off at about 10% and then started declining into a healthy market environment. In similar fashion, right, with all of the tremendous amounts of layoffs and people not working jobs and stores closing down at the start of the COVID pandemic, we reached a high of 14.8%. The government stimulated by printing, trillions of dollars, something we call QE, quantitative easing. And in that time frame, people started going back to work, even if it was remote, using tools like Zoom, only to see a new all-time low in unemployment at 3.4%. And we ranged there for quite a while, basically from February of 2022 all the way to October of 2023. And then we've started ticking up. And now we're starting a new trend where we are consistently putting in new highs at 4.1% on the last reading. And then on April, 29th, right over here, we're about 4%. So we are putting in new higher highs and higher lows. And in similar fashion, whenever we start to do that, as you can see here, before we continue ticking up through the recession, and this is typically a lagging indicator. That means when we've peaked, usually we've already bottomed and started the recovery. Okay, and I'll go ahead and pull up the S&P 500 chart. So as you can see here, right, if I were to, let's say, replay it, right around here as we're ticking up, this was December 31st of 2007. You'll notice that unemployment is starting to tick up and trend up now from its local lows. The recession hadn't really been in yet. As unemployment is trending up, well, guess what? The market is putting in new lows. And I'm going to go ahead and just play that out for 2 more seconds. Around the same time there, the market had bottomed out and then started its recovery into a new all-time high in a bull market environment. So that said, this would be a lagging indicator, but what I'm really looking for is a trend to the upside. Now, this doesn't really help when you have someone from the IMF basically advising the U.S. to keep interest rates high. Right here it says IMF Managing Director Kristalina Georgieva, right, said this: "We expect core PCE inflation to end this year around 2.5% and be back to target by mid 2025. This being said, we do recognize that there are important upside risks to this path. Given those risks, we agree that the Fed should keep policy rates at the current level until at least late 2024. But if they continue to keep interest rates high, it is going to hurt the labor market because it basically slows down economic growth and activity. It de-incentivizes companies and individuals to borrow money then and go and spend it in the economy. And as less companies and people are borrowing and spending money and the economy starts to slow down, companies can't afford to operate to the same degree, right? And so typically as people spend less money, then they lay people off, right? Because the demand simply isn't there. And then it has a negative downward spiral effect where as more people get laid off, they don't have as much money to spend, or maybe unemployment doesn't pay as much, so they file for unemployment, but now they're just taking care of their basic necessities and bills, and so on and so forth, right? They spend less money, so companies produce less things, and more people lose jobs, and eventually we get a bottom. Now, that said, And the IMF managing director recently met with the Federal Reserve Chair Jerome Powell and U.S. Treasury Secretary Janet Yellen to discuss why they should keep interest rates high, and it would be good for the U.S. and the G20 economy and basically the entire world. But that doesn't necessarily help when now, you have a report from the IMF also saying that AI could turn the next recession into a major economic crisis. Historically, companies have continued to invest in automation even during economic downturns. AI could amplify this trend, leading to greater job losses. And we already know that the whole world was obsessed with AI over the last year, 2 years, as OpenAI with ChatGPT really kind of revolutionized the world of AI and gave the average person access to these tools, which is really such a game changer. But that whole path, and there was a period of time where at press conferences, as long as the CEO of a Fortune 500 company mentioned the word AI, their stock would rise. People were buying into that speculation, right? Well, approximately 30% of jobs are at a high risk of being replaced by AI, compared to 20% in emerging markets and 18% in low-income countries. So that means the biggest consumer economies in the world, and the ones that are really holding up this whole global sphere of money and fiat and growth, are at major risk. And if they're at major risk and their economies start to dump, I can assure you that low-income countries and emerging markets will also dump. While AI can enhance market efficiency, these sophisticated models might perform poorly in novel economic situations, leading to erratic market behavior. And you know what markets hate more than anything is uncertainty. Based on erratic market behavior alone, markets can sell off even further than we would expect. So when we look at something like this website, layoffs.fyi, as you can see here, that we had a very low amount of layoffs back in 2022. And I'll go ahead and refresh this just to make sure that we have the proper data here. I guess they're just not going to show 2022, right? But right back here in 2022, we had in trending growth in layoffs, right? And so you can see that this is the blue line is indicative of companies with layoffs, whereas the orange line would be employees laid off. Down below, we have tech layoffs since COVID-19. And so right here, these are very similar charts, right? Tech layoffs through 2022 through 2024. Here's just tech layoffs since 2020. And so as you can see here, 2020, we obviously saw quite a few layoffs, but then with the economic stimulus and money printing and government basically bailing out the entire world economy, right? There were virtually no layoffs as the market continued to rally on that QE. But then when things started to slow down, right, companies were actually preemptive and said, we fear a recession is coming. We see the markets are, trending down. There's a slowing in the economic way of life. People are spending less, so on and so forth, right? And so there was a lot of talk of recessions. The market did dump tremendously. A lot of major tech darlings dumped somewhere between 70 to 80%, some of them even 90%. So obviously, companies would lay off into that situation. Well, now we started this long trend down. And if we remain at these lows with high interest rates, it remains to be seen, but I would thoroughly expect companies to preemptively, again, start laying people off. And so we might potentially see this trend tick up. And the data is already showing that the trend is ticking up. When you look right here at the civilian unemployment rate, we'll go ahead and do that. We'll X that out. So you can see that we are officially trending up, and that is not a great sign. That means if this thing continues trending to the upside like it did in previous recessions, then the market would likely be dumping right into here and then bottom out as we reach a new high. And I don't know where that high is. I don't think, this is just straight up drawing lines. I don't know where that high would be, but eventually, right, the Fed is going to have to step in. And the only way they usually step in, right, is by lowering interest rates. I'll go ahead and pull that up right now. Lowering interest rates from their terminal peaks, right? And in this case, it would be 5.5% right here, down to, basically really near zero levels. The lowest we've ever reached was basically 25 basis points or 0.25%. We did that right back here, at the end of the Great Recession. We did it again for COVID. And in other words, right, the Fed is usually late to the party. They usually respond to an economic recession or a major market downturn. They're not doing it proactively. So it's really important to know that we are not out of the woods just yet. And especially when you look at something like the VIX, right, trending to new lows. The last thing I'm going to share, which is kind of scary, and at this point, since there's so much uncertainty, I would say it would be wise to hedge against risk, but not necessarily to the point where I'm selling out of all my positions. Now, that is not financial advice, but let's just go ahead and look at the S&P 500 after we talk about this for just a second. With the VIX super low, typically what happens is when you see the VIX rise, like right back here in 2020, all of this volatility is indicative of a major downturn or some sort of a down move. If I were to pull up, let's just go ahead and do that real quick right here. I'm so tired of drawing lines on accident, guys. Let's go ahead and do that. Bam. Okay. So I'm going to remove this drawing. And right here, I know it's kind of hard to see all the way, but right here, as you can see, right, the VIX climbed up a little, right? And then the market was dumping in similar fashion, right? Right up here, right? Local top, market dumps, VIX climbs, right here. Right, we saw the VIX really radically, behaving erratically into this downturn. So whenever you see the VIX chilling at all-time lows for a sustained period of time, that typically means that the market has been trending up and not really dumping that much. But here in the near future, and as you can see here, similar fashion, right, in the near future, it's likely we're going to get a dump. And if we look at the S&P 500, and this is what really is concerning me right now, let's go to that S&P. We've been really trending up, and we've been bouncing off that 10 EMA for quite some time. Let me go ahead and pull that up. 10 EMA right there on a daily time frame. You can see that we are deviating tremendously, right? We're just pushing out further and further away from that 10 EMA. But in an uptrend, whenever we push further away from the EMA, or in other words, deviate, then it's likely that we're going to start to revert to the mean or come and break back down to that EMA. So I'm not really loving this price action when I consider it against the Dow Jones. So as you can see here, and I'll just go to a lower time frame, consistently been putting in new higher highs and higher lows on the S&P 500, but this is what worries me from the Dow theory perspective, is that the Dow Jones, right, which is another major index, actually recently sold off tremendously on a potential breakout. The market tried to break above this range high right here at $39,430, only to get sold off again. So since May 20th of 2024 right here, till present day, the market has actually failed to break out and put in a new all-time high, while the S&P 500 has consistently been printing new all-time highs. You can see this is May 20th right here. Let me go ahead and track those against each other now. Right here, we'll do the Dow Jones up top, and I will auto that out. So as you can see here, right, highs right here. This was a local high on both. You can see they were trading very correlated, right? New highs on both, kind of a double top-ish on the DJI. But then the Dow Jones started dumping. The S&P 500 started dumping. The S&P 500 rallied like crazy through this next month from, May 20th all the way, well, technically the bottom of May 31st, all the way through present day, while the Dow Jones has failed to break new highs. And that is kind of scary, okay? Because what that's signaling to me is that there is some serious weakness in the market, especially when you look at like the Dow Jones. Let's go ahead and pull that up. the Dow Jones Transportational Average has not only been ranging, but it's actually been very weak relative to the S&P 500. As you can see here, we are at major lows, basically all-time lows. So this is typically a leading indicator of recession before we start to revert back to some sort of a mean up here at the 3 range. And so this is very, very, in my opinion, very bearish. But what this is the market giving us early warning signals of a potential recession. So let's come back over here, put one chart up, and I will do one last thing, and I'll just show you this indicator before we get into an approach and a strategy for crypto, because I know that some of you guys might be watching this video like, well, I'm just here for crypto and what should I do? Well, I'll tell you right now, if the general market is weak and the whole economy goes into a recession, then cryptos are going to absolutely get obliterated. They're treated very much like risk on assets, right? And the majority of institutional investors are not going to be there to support a meme coin and arguably any altcoin, even if it is a good technology, because they're already selling good technology companies in the form of any stock that is in the top 500 companies in the US. So why would they hold any altcoins, right? Even though it might be a great idea and it might be a great technology, I'd rather sit the risk out and hold, a government-backed bond or the US dollar, even if there is inflation upwards of 10%, or even if I'm only getting 5% back on a bond, 4% back on a bond, versus potentially losing 50 to 90% of my entire portfolio value through an economic recession. So they're going to sell those assets off, and as more and more people do that, the markets continue to dump. So that said, the final thing I'm going to do is I'm going to pull up a correlation indicator, and we will go ahead and do that. And so as you can see here, typically this right here is a correlation indicator that is tied to the SPX or the S&P 500. In typical fashion, right, you'd see this thing hanging out up here upwards of 100%, somewhere in that 90 to 100% range. So as you can see, right through this major move to the downside from the top of 2021 down to the bottom of 2022, right, they were highly correlated. That means they were both moving relatively correlated and in similar fashion. I can pull that up right now and show you. Why is it not popping up? Oh, because we are not on a percentage scale. Let's go there. So as you can see here, very correlated, right? One would move up, the other would move up, one would move down, the other would down, so on and so forth. This orange line would be the S&P 500. The candlesticks would be the Dow Jones. And so they are highly correlated. Now, what was interesting is when you would start to see these negative correlations. One is dumping right here while the other is pumping, okay? Now, what I'm really after is seeing a negative correlation that could potentially signal some general market weakness. And right here we had it, right? Right here we had a negative correlation. In other words, the Dow Jones is moving against or opposite to the S&P 500. So it looked like the Dow Jones failed to break to new highs while the S&P 500 was breaking into new highs right here, which signaled market weakness. That market weakness allowed for the market to dump, quite a bit. And in similar fashion, right here, look, S&P 500 pumping really hard, Dow Jones failing to move to new highs. So look at this. It's rare that we get this type of a signal, but we're consistently getting a weaker and weaker correlation and arguably consistently touching that negative zone. And so this is very, again, indicative of, a potential bear market. So I'm not really too bullish on the market as of right now until something changes. But does that mean that we should be selling our crypto positions? Let's get into it. So here we have the chart of Bitcoin, and I remember there was a period of time where we hit the previous all-time high and ranged for a while. I'm on a daily time frame. Now, it wasn't that long before we started printing new highs and really deviated from this is a 55 EMA. I'm just using it based on a fib scale, very similar to the 50 EMA. But in general, that red line is a 50 EMA. The white line is a 200 EMA. And I remember seeing the market start dumping a bit, and it dumped and touched that 50 EMA, only to start bouncing into new all-time highs. And so I used this as a good indicator of a support. And I'm glad I held through that range because we continued printing new highs. And I held the majority of my altcoins through this range as well. Now, I'm going to tell you about a mistake I made that really didn't make me much money. Luckily, I was out of the market after a certain point in time, but I did not make money through the range. So I made money through this entire move, okay? But where I failed was that I did not accumulate during a range. Now, once we started breaking down below this EMA, I started keeping a close eye on the price. And really what I was focused on is seeing a downtrend. But I didn't have the courage to get out right after this move because I'd already seen it break down, as you can see right here. Right? But then I saw it break right back above. And by this point in time, I held. And so I held through this major move right here until it started breaking right here. And the problem with that was I started selling through these local highs, and especially right here, because I figured, well, we just got resisted right here. I started seeing the breakdown right here. So I started getting out. Now, let's go ahead and remove that and just focus on the price action here. I'll do a bar replay. And so as you can see here, we're just going to play it out for a second. And at one point in time, we had a new local low right here that was touching previous lows from a wick perspective. And I figured, you know what? I'm going to wait for the market to turn around and for us to print a new high. I started buying a little bit of a position right here because I could see that we're seeing some strength. We're seeing a new lower high. And let me just play it out for a second. But then we broke back down. And again, because of poor risk management and my inability to really just trust my stop losses and what I want, not what I wanted out of the market, but what I should have been doing, I held through that range only to see the market break right back down, where I started selling back here into the $35,000 range down to $32,000. And I felt really good about that trade for just a minute because I could see that we broke our previous range lows and started putting in new lows right here at $30,000. Right? And then I just held out of the market for a bit. And then I saw the market continue breaking down. And again, I felt that relief that I had made the right decision. And right around here, I remember putting on a short, but luckily I practiced some good risk management. This was with a bit of leverage, and I was immediately stopped out above this range high right here when the market turned back around. Now, where I really messed up was that I was watching these ranges right here and was actually selling short for a bear trap. People were wanting to be bearish here only for the market to flip right back around. Now, this could have been due to leverage. It could have been due to bankers playing the game, whatever. But I actually held out of this move because I just wasn't making the right decisions throughout this entire, range down here, only to see the market climb right back into those new all-time highs. And so when I pull up the EMAs, as you can see here from a daily time frame, we were actually below the 200 and the 50. And most people will look at signals like this and say, well, we just had what you call a death cross, right? It's when the 50 EMA crosses under the 200 EMA. But if you would have sold right here, that would have been pretty foolish, right? You were extremely close to those local lows and bottoms, only for the market to continue trending up. And so I could take a trend line, right, and drag it through this range right here. And as you can see, we actually consistently were trending up. It doesn't mean that we weren't putting in an intermediate term downtrend. And you know what? Let me just remove those drawings to make it real simple, right? The EMAs are screaming sell. We're putting in an intermediate term downtrend. Try to get it as best as I can right there from this local low to this local low. But longer term, we were still trending up. Right? And the price proved it by putting in a new high. So through this range, we were still trending to the upside. Now, you wouldn't have known that at this local low just yet, right? But ultimately, even at this point, we were trending up until we broke down below that trend line. And then everything else started screaming, run for the hills. Now, I made that mistake. And ultimately, I think I sold out. I made the majority of my money on this move, only to start selling out a little late right around here through here. And I I just am telling you, I sold a little too early. The similar thing happened with XRP, but let's just play it out through current present day. As you can see here, we have a new lower high, but we're still trending up, okay? And I guess the moral of the story is that typically when we touch those previous all-time highs, like we did right back here, even if we're not like breaking out to new all-time highs really quickly, chances are we're putting in a new all-time high right here, right? And as long as we hold this uptrend, in other words, we get a series of higher highs and higher lows. So what I'm really focused on right here is this is our low, okay? This is our next low, high, right here, double bottom, new high, new low, new high. As long as this low, right, is higher than this low, then we're good to go. So really, I want to focus on accumulating through these ranges is what I'm trying to say. This is not for me just the end all be all sell zone. And I know there's a lot of, economic factors that might play into this that are a little bit scary. And although I am seeing a lot of general market weakness, I want to continue to accumulate, because even if the market does dump to here, right, $42,000, I think we have a boatload of support and we're still trending up pretty tremendously. So these lines don't need to be perfect, by the way. There is no perfect way to do this stuff. But right now, if I pull up that VRVP, we do have a boatload of support at the $47,000 level and then again at the $42,000 level. And so you can see that a lot of people have interest at these ranges right here. So in this range, I want to be accumulating even if the market continues its downtrend, right? Because we're trending up long term, even though we are in an intermediate term downtrend. Now, when I look at the chart of something like XRP, in similar fashion, right, we have a boatload. Well, let's look at the actual longer term XRP chart. Here we have it. Bitstamp has a lot of volume and, time. Right here, we have a 38-cent range with stupid amounts of volume. And even long term, we have a boatload of volume. I mean, this entire range from 38 cents down to 20 cents has so much traded volume that I just don't see, unless we hit some sort of a crazy black swan event where the market doesn't dump, but then XRP doesn't get bought back up like crazy. So is the risk of me not being in the market and in a move up to back to the previous all-time high of 330 not worth, right, holding a bit of risk through here and arguably accumulating through a range like this, dollar cost averaging down to the 30-cent range if we dump there, then not being in it at all, selling a little too early, only to see the market turn right back up into those previous all-time highs and making the same mistakes I did in the previous bear market, or the previous move on Bitcoin that I just explained, right? Ultimately, I'd rather accumulate through these ranges. So the real question is, will we see the market continue to crash? And I think some of the recent news around banks going insolvent or bankrupt because they're holding too much debt on their balance sheets has really caught the eye of a lot of investors and people. And in this article from the Wall Street Journal, it says the biggest banks can withstand severe downturn. $685 billion in losses, the Fed says. This year's exercise measured 31 biggest banks' ability to maintain strong capital levels in a hypothetical recession. The banks would collectively lose nearly $685 billion in the Fed's imaginary worst-case scenario. The bank balance sheets are somewhat riskier and expenses are higher, Michael Barr, the Fed's vice chairman for supervision, said in a statement. This year's stress test included a severe global recession in which the U.S. unemployment rate jumps to 10%. And so we've seen 10% even at the worst lows and at the bottom of the 2008 Great Recession, right? Housing prices crashed by 36%, which is, pretty tremendous. And commercial real estate prices dropping by 40%, which, we're almost already there on the real estate commercial prices. However, the stress tests were introduced following the 2008-2009 financial crisis when the U.S. government bailed out some of the largest financial institutions. And so what they're doing is testing the overall, banking sector to make sure that we're not in a situation where things fail. And if you guys remember, not too long ago, 6, 7, 8 months ago, I can't actually remember, like 2023, we had quite a few banks that were basically insolvent, and the FDIC basically bailed them out and restructured them. It got to the point where they restructured the debt, other banks bought them out, so on and so forth. And so we've actually built a lot of systems in place where if something were to happen with banks this time around, it really wouldn't have the same knock-on effect on the market that it did in 2008 and 2009. So I'm not really as worried about bank failures causing a great global recession. I'd argue that it's going to be more so on the side of keeping interest rates higher for longer. Banks might be safe, right? But then your job might be in jeopardy. And so I think less spending and AI would be the biggest risks in this market. And, obviously we're seeing some of those effects play out due to Dow theory with the negative correlation between the S&P 500 and the Dow Jones. Now, does that mean that you should go and sell? I don't think the bull market's over just yet. I think crypto still has, some legs left in it. And I would argue that ranges like this would be a major buy zone when everyone is bearish and we're experiencing a summer lull. So that said, I will be accumulating XRP. I will be accumulating Bitcoin and then virtually all of the other altcoins that I'm excited about through these present prices. And if the market environment changes, well, then guess what? You should be subscribed to this YouTube channel. Go ahead and like this video, because guess what? If you're subscribed, you're going to get more updates from us as the market environment changes and we reach some, potential pivot points, so you can be better educated about making decisions with your portfolio. So thanks so much for watching the video. I hope you enjoyed it. I hope you learned something, and I look forward to seeing you in the next video. Goodbye.